Welcome. My name is David Ripplinger, Extension economist with NDSU Extension. I'm the regular host, moderator, organizer, troubleshooter, if need be, for our monthly webinar series. This is a special webinar, our second on trades and tariff and their impact on North Dakota agriculture. We'll get started in just a few minutes with a few presentations and then have a question and answer period at the end of that. We've been doing this webinar series for quite some time. It's part of our service within Extension to provide unbiased, science-based information to help folks in the state be successful. We've been doing this for a bit. We are recording it. It will be archived on the NDSU Extension YouTube webpage. It usually takes a day or two to come up for that. You are all muted, but you can ask questions using the Q&A tool or the chat, and you can use the chat tool to communicate with me if you have any unique needs. With that, I'm just going to go ahead and hand it over to Brian, who will kick us off once again. Thanks.
All right, I believe it's the 25th. I think the title
it is. You're right.
21st, but no worries. I'm going to share my screen. So I just wanted to do first of all, as far as some of the macro stuff goes that I talked about before in some of these trade scenarios. In a lot of ways, not much has changed from the policy standpoint that existed a few weeks ago when I was talking about some of the macro implications. I know some back and forth between China and the U.S., but we had the basically extension of the delay on some of the tariffs that were proposed in order to give time for negotiations to go forward. But one of the things, I guess, terms that are being thrown around in the news these days has been stagflation. Okay. And in fact, I didn't put the chart on here for copyright reasons, but there are these sites that they take buzzwords that might be used in the news and kind of aggregate them and see how many times this phrase has been mentioned. And this one has been a hot topic, at least for the last week or so. And so where did this term come from in general, in case you're wondering? And it's the combination of basically two words: a stagnant economy plus high inflation, stagflation, essentially. And it's also important to remember where the fundamentals that create an environment that are inflationary. And as I've said in many presentations in past, and this is a bit of a simplification, but there are really three main triggers for inflation. You've got demand pull, which is typically a rapid growth in demand that outpaces what supply can provide or the supply can produce. And as a result, prices go up because demand spikes really quickly and stays elevated for a period of time. Then you got the supply push inflation. Typically, that's where production costs, maybe wages, costs of raw materials, costs of energy, for whatever reason, goes up relatively quickly. That pushes the cost to produce whatever goods we're looking at up, and then prices go up, which is inflation. And then the final one is monetary or fiscal policies, where the money supply is increased at a rate faster than GDP growth or economic growth needs, and as a result, then you have inflationary pressure on prices, basically just increasing the money supply faster than necessary. That's a very simple explanations of those, but sort of basically covers most of it. So here's kind of the requirements that are necessary for a stagflation scenario. High inflation, and I put it in quotes because, what is high inflation by definition? I mean, one person's statement that inflation is high, I mean, somebody else hears that and maybe they don't think it's quite that high. The Federal Reserve's target for inflation is 2%, or right around that 2% mark. So I guess maybe we would call high inflation 4%, 5%. Right now, inflation is still higher than they'd like, and is sort of dictating their economic policy or their policy related to interest rates. But, we've seen inflation much higher than this. We've seen 10% and 15% in the past, and that certainly would qualify as high inflation. Then the second part that's necessary is slow or no economic growth. I mean, really low growth or very, very slow. And then I bolded this, but the other part is high unemployment. And one of the things that's sort of the conundrum with stagflation is that typically high unemployment leads to uh, uh, lower prices, because folks who are unemployed or worried about becoming unemployed in the future because their neighbors and family or friends are being laid off or let go, do not spend as much money either, because they're nervous about the future, and that helps keep prices down. So when you have a stagflation scenario, it runs counter to that, because you have this high unemployment period and you have prices continuing to rise, which that typically doesn't happen. There has to be a lot of times an outside influence for that. Now, this phrase came about in the 1970s, and I'm about to show you why here in a minute. So here are the data from the 1970s. I ran this chart from 1960 to 1990, and you've got the unemployment rate, so that's green, the CPI or inflationary index, so that's red, and this is all items, so headline inflation, and then GDP growth, percent change from a year ago, but quarterly, and that's blue. And what you notice in the 70s, so this line here is 0, you had periods of GDP growth. So let's look at the blue line here. 0 around in 1970 for a period up through 71, 72, maybe up near 5, then below 0. So a bit of a recession here. 74 into 75. Growth comes up down to around 4, then back down 0, 2%, below 0 again. So really just a little bit volatile, but mostly a low economic growth period all the way through into the mid 80s. While at the same time, you look at the CPI, you had inflation in the mid 70s above 10%, higher than we've even seen in this most recent run up. And then again, in the late 70s, inflation almost hitting 14%, while at the same time, we had unemployment in the early 70s here. You can see it was around 6%. By the mid 70s, unemployment had popped up over 8%, then down again, and then in that very early 80s period where we had a big recession there in the early 80s, up near 10%. So again, you look at this chart, you can see we had much higher than we would like to see inflation, relatively high unemployment. The target during this period was 5, and so it was comfortably north of that, and then relatively low economic growth. All right. So let's start taking that information and applying it to what we see going on today. Here's the CPI, so Consumer Price Index. This is from the St. Louis Federal Reserve, and the unemployment rate. So coming out of COVID, so I know it was really high here. That was coming out of the COVID period. And once things stabilized, the unemployment rate's been anywhere between 3 and 4% now for the better part of 4 years. Okay. But we had that high inflationary period with 2022, really, we kind of peaked there around 8%. Then the Federal Reserve, as we recall, increased the federal funds rate. It increased then indirectly, but influenced interest rates. And we've gotten inflation down around, for at least for headline, between 2.5% and 3%. Still higher than they'd like. Again, that target being 2%, but obviously much lower than 7.5 or 8, which is where it peaked. But all the while, unemployment has stayed pretty low. Even the fact that they increased rates pretty rapidly, even on a historical perspective, not anywhere near as high as record rates, but did increase them quickly. It didn't have a big impact on unemployment, not as big as you would have thought that would have, if you would have compared it to periods from decades past. And then when we look at GDP growth coming out of the recession from the pandemic lockdowns here, you can see it a bit of a strange period in the first quarter of 2022, but really by and large since then, GDP growth has been kind of ranging between about 3.5%, 2.5% to 3.5% quarter over quarter, all the way into the end of 2024. So pretty steady GDP growth despite the higher rates, and a reason in a tight labor market for that matter. All right, so if we look at what the labor market, what the situation is moving forward, I like to show this chart here, and this data is from the BLS, but I pulled it from the St. Louis Federal Reserve. It's the number of job openings to the number of job seekers, okay? And so when you look at it, we all recall the Great Recession, okay? The big recession that occurred 08 to 09, and that's this kind of gray vertical column here. The number of unemployed people to the number of job openings, that increased all the way to almost 7. So in other words, there were 7 unemployed by the mid 2009 for every job opening. So 7 people looking for work for every job opening. That number had steadily declined all the way through to 2018 to where it was less than 1. In other words, there were more job openings than there were people looking for work. Then we had this COVID spike right here. And again, as we moved into 2022 and a lot of that had settled out, this number actually was down around 1/2, implying that there were 2 job openings for every person that was looking for work. Now that's come up some here over the last 2 to 3 years or so, but right now it's right around 1 or just slightly less than 1. So in other words, there's 1 job opening for every person seeking work, which is still a very tight labor market. So how did some of that happen? Well, this is the labor force participation rate, okay? And this is going back to 1970, and we saw a big increase in the 60s and then into the 70s, peaking really in 2000 in the labor force participation rate. And the big reason for this increase was women entering the workforce, entering the labor force. And again, this peaked at about 67% in the mid 90s through 2000, where before that it was below 60%. And if we come to today, we can see that really since that peak actually in 2000, but moving forward, that labor force participation rate has been in steady decline. Then we have the pandemic where it dropped precipitously and then rebounded back up to about 62.5%. And then the last number, it's kind of hard to see here on a timeline this long, but 62.2% is kind of the most recent labor participation rate statistic. And to the last time it was roughly that low was the mid to late 70s. All right, other than the pandemic period, but I'm kind of ignoring that a little bit because that was a special circumstance. And this is just a zoomed in version of the chart that I just showed. I wanted to zoom in on the most recent few years. You can see that right there, that basically as of February 2025, there were more job openings than there were people looking for work in the US. So the labor market remains fairly tight. So again, I go back to one of the principal components of stagflation is a high unemployment rate. And that high unemployment rate helps create that low growth period because, as I said before, unemployed individuals or people concerned about being unemployed do not spend as much money. They're not buying homes, they're not buying cars, which keeps prices sort of depressed. Well, that high unemployment period right now doesn't seem to be coming at us like it did back in the 80s and the 70s, and then even into the Great Recession, which wasn't all that long ago, about 15 years ago. So why is this labor participation rate continuing to fall? Okay, and this is labor participation rates 1970 to 20. This is projected by the Congressional Budget Office. And these labor participation rates among men and women are all projected to decline. Now, this includes all ages. This is everybody basically able-bodied from the age of 16 all the way until death. This is expected to decline. And I've heard comments as I've shown some of these labor statistics and been on the road about it. Is it people just not willing to work, people not wanting to do anything, those kind of factors. And in the data just says really no. That's not actually the main reason for this labor participation rate decline. So this, again, from the same report from the Congressional Budget Office, in 2023, I just want you to look here at the 30 to 39 group age category. That was in 2023, that was the largest age group in the United States. All right. And by far and away, most of them were in the labor force. You had a share that were not, but by and large, that was the biggest share of the labor force. And then you have the 70 plus group nearing or in retirement in 2023. 30 years into the future from that report, really about 28 from now, I want you to look at how big the 70 plus group is compared to this 30 to 39 group. The 30 to 39 group declined relative to the 40 to 49. The 60 to 69 group increased a bit. This 50 to 59 group increased a bit, but this 70 plus group increased dramatically. This is age of the group, and this is in millions of people. So the 70 plus by 2053 makes up the largest share based on this demographic set of the population. And then you move to 2097, and that 70 plus group, far and away, based on how this is divided up, makes up the largest share, whether you include 20 to 29, 30 to 40, 40 to 50, et cetera, et cetera. And so what is that creating? It's creating a scenario where a lot more people are a larger share, not just a lot more people, but a larger share are moving into retirement age, and they're counted in the labor force participation rate. So as you get more and more people, a bigger and bigger share of the population age 65, 66, or 70 plus, they move into retirement. Even though they're counted in the labor force participation rate, they're not in the labor force because they're retired. So that's a big reason why this number has been dropping and continues to drop and is expected to continue to drop decades into the future, which then brings us to the tight labor market that we're seeing today. And depending on how job creation goes, and when you think about some of the comments that have been made and the ideas about tariffs and what that's supposed to do, perhaps bringing manufacturing back into the U.S. of certain goods and durable goods, products, automobiles, all kinds of things. This is what the labor pool is expected to look like, and folks are going to have to go on and fill those. So circling back to the stagflation comment, I'm not sure, based on the definition that we've held for what stagflation is, that's going to be a serious issue in the near future, mainly because the labor market is just in a place right now where the high unemployment doesn't look like it's on the horizon yet. Okay, now things can obviously change, but the demographics of the U.S. right now, and if a bunch of jobs are going to be pulled back, into the United States, that's going to probably put more strain on the labor market, making it more of a I guess if you were thinking of a power struggle, a lot more power in the hands of the workers than the actual than management as far as that goes. So I personally am not concerned about a stagflationary environment as it's been defined historically and like we saw in the 70s. But I will say, though, that the potential for supply costs to increase is certainly there in the short run as we work through a lot of what these trade negotiations are going to look like, and whether they're bilateral among different countries and whatever deals are cut in the short run until a lot of that's worked out. If the tariffs are indeed increased to what's been stated, that's probably going to have a short run impact, driving some of those supply costs up. But this is sort of how it shakes out there. So I just wanted to, with this, talk about, a lot of terms are thrown out there, and we see them in news outlets and news sources. Is stagflation going to be a problem? Is it on the horizon? Those kind of things. And, it's important to understand what goes into those phrases and those meanings and what actually makes it up and what scenarios would actually have to transpire in order for that to be the case. And so I just wanted to kind of share that with you here based on what we're seeing right now. And again, I'll be on at the end to answer any questions. And I believe our next speaker is Dr. Olson. So I will stop sharing.
All right. Thank you, everybody. Good afternoon. Frayne Olson, crop economist, marketing specialist with NDSU Extension. As always, here's my contact information. If you do have questions or things that you want to follow up privately, I'd be happy to do that. There will be time at the end of the session here to try and answer some questions directly if there are any. So today I wanted to give you an update on what is the current tariff status. So it took quite a while to put this together, to be very blunt. I leaned pretty hard on some notes, some materials that I already had, but also I got from the budget lab at Yale University. So combining a lot of things. So if there are mistakes in this, if there are errors in the dates and the percentages, they are mine, because I tried to compile this from a lot of different sources, but I did lean pretty hard on the information from Yale. The only reason I wanted to go through this is here's kind of a timeline. This is what the U.S. did from a tariff standpoint. These are the retaliatory tariffs from some of our trading partners. And I wanted to highlight specifically what are some of the things within the ag space, within our U.S. agriculture that have been targeted or that we need to be watching pretty specifically. So the moral of the story is there's been a lot of discussions in particular on what the U.S. is doing, the implications for global trade, obviously the things that Brian just talked about for the U.S. economy and inflation and unemployment rate. What does this mean for consumers? What does this mean for industry? There's a million different questions going on here. It's very hard to keep track of not only what the U.S. is doing, but more importantly, what are some of the retaliatory tariffs. So I wanted to try and put this together just as a reference. Don't worry, I'm not going to go through all of these right now. That's not my purpose, but I do want to give you a general idea of what's going on. So if you are looking at this in a recording, you should be able to pause it and you can see, specifically what are some of the things that have been tariffed. So we started basically in February and then with an update in March. Some tariffs on the Chinese. Their initial 10%, then it went to an additional 10%, went to 20. China did retaliate. It wasn't until the March retaliation that we started picking up some restrictions or additional tariffs on U.S. ag products, and this was the list. Now, since then, this has basically become irrelevant. Then also in March, there's 25% tariff on all Mexican imports as well as Canadian of selected Canadian imports. Canada retaliated and included several agricultural products within the retaliation. So there's a 25% tariff on most of these products. So wheat and barley and sunflower and canola were included in that list. Now, again, continue to move forward in time. Later on in March, we had the 25% steel and aluminum imports. Canada did place tariffs on a long list of U.S. imports, primarily iron and aluminum-based products like cast iron and pipes and fittings and some computers, clothing, hand tools, etc. There weren't any additional agricultural products that were added to that list at that time. 10% tariffs on Canadian potash and energy came and went. So again, that would be products that might impact agriculture, in particular on the potash side, but there was no retaliation from the Canadians. And then there was the big day on April 2nd, where we put 10% minimum tariffs on all countries and products. And there was additional reciprocal tariffs, that was the term that the White House used, on selected countries. So each country there was the 10% base, and some countries had additional tariffs on top of that 10% base that were added. Okay, so these reciprocal tariffs did not include Canada and Mexico. So the things with Canada and Mexico, with the fentanyl and immigration, as well with steel and aluminum and automobiles, did not get increased. However, there was the import tariffs on Chinese products moved to 125%. And in retaliation, or basically as a result of that, China placed 34% tariff on all U.S. imports, period, which included essentially all ag products. Now, that would primarily be obviously soybeans from the grain side, but there's also some meat products, and I know Tim will be talking some about that. Then a few days later, there was an announcement that the reciprocal tariffs, so those additional tariffs on top of the 10%, would be paused. There would be a delay in implementing those. So the 10% for all products is currently on, okay? But the additional tariffs for country-specific, the retaliatory part, or the reciprocal part, were paused. Now, as a result, that really has now stimulated a lot of discussion about coming in with bilateral trade agreements, which I'll talk about in just a moment. So then, on that same day, when there's an announcement of this 90-day extension, the U.S. increased tariffs on all Chinese products to 145%. So going from 125 to 145, I'm not really sure, to be blunt, whether that made a huge difference, but it was it's part of this tit for tat strategy that you often hear about. Well, as a result, then China increased tariffs on all U.S. products to 84%. And then a couple of days later, they came back and said, no, we're going to change it from 84 to 125. And that does include all U.S. egg products. Now, at this stage of the game, and this is a timing issue, for U.S. egg products, especially for the grains, we're not selling a lot of product to China at this time anyway. So China has bought very little corn, very little wheat from us this whole marketing year. They have bought quite a bit of U.S. soybeans, but that was long before all of these these additional tariffs were in place. And so this time of the year, as we get into spring planting and into the summer months, and I'll show you some graphics in a little bit, China typically doesn't buy a lot of grains from us. But again, I'll let Tim talk a little bit about the livestock side. Now, just more recently, the U.S. did exclude some Chinese built smartphones, computers, computer equipment, some electronics from the 125% tariff. So there is still some tariffs on these products, but they have been reduced. Okay, now my point in bringing all this up, this column over here on the right-hand side, except for some retaliatory tariffs from Canada, and obviously the ones in China, agriculture really has not been dramatically impacted. The Mexican government has said that they were not planning to have any retaliatory tariffs at this time, but they were considering something in the future, depending upon how negotiations goes. So unlike the first trade war, this is my moral, unlike the first trade war, where U.S. agriculture, in particular soybeans, but all ag products, was really the target of the retaliation from China. This time, yes, China has retaliated, but the economic environment's very different, and the timing of it is very different. The first trade war, those tariffs went on basically in the middle of our peak export season. So this was a time period when China was buying a lot of our products from us, is when the first tariffs were around. Now, we're basically past our peak export season, and we're into this quieter time for U.S. export sales. So the impact on agriculture has been very different. The other countries have not retaliated, which is one of the really, really big concerns going into this, the announcement for all these reciprocal tariffs. So right now, who are the current countries that are discussing or negotiating, if you will? I don't know if negotiating is really the right term to use, but at least discussing tariffs and renegotiating or coming up with trade agreements. Now, this is my list. I probably have missed some countries somewhere along here, but I do want to emphasize these are bilateral agreements. So these are individual trade agreements that are being discussed between the United States and these countries. So just to read them off quick, Japan, South Korea, very big buyers of U.S. grains. Fortunately, our sales into those countries have not been significantly impacted yet. Growing economies, or economies that we might be able to get additional ag products, our U.S. ag products into these countries, would be India, Vietnam, Indonesia, are all talking. Great Britain has come in. We have been talking with Great Britain about a trade agreement for several years now, so hopefully this will push the negotiations along. The European Union is going to be very difficult, in my opinion, just because A, there's so many countries, and B, that's a very complex system, and they have a very integrated system, not only within their internal trade agreements between the countries as part of the European Union, but then also as the Union versus other countries. Italy has come to the United States. The head, I believe it was the finance person from Italy, came to the United States, talked to President Trump. I think the thought was, at least based on press reports, was that, if Italy were to step forward and start these discussions and negotiations, hopefully other representatives from the European Union would come along and follow. Taiwan, also another really big ag buyer from the United States, especially for corn and wheat. Argentina has come in. Israel, Bangladesh, Cambodia, Lesotho, Australia, New Zealand. These are all countries that have expressed interest and are currently talking that we know of publicly. There's probably others that might be talking with the current administration, but it's not come out in the press yet. And of course, the big wild card, you've been probably hearing about this over the last several days, is what about China? Are negotiations going on with China or not going on with China? I'm really not sure. Nobody's asked me, nobody's told me, so I'm just trying to go off of what I hear in the press. So, in my opinion, the Chinese trade relations are going to be very complicated. I think the best case scenario would be to have a pause and hopefully a retracement or reduction in tariffs as they sit down and talk and try and negotiate. But please recognize these negotiations, in particular with China, will take considerable amount of time. When we looked at the phase one agreement, the one that we had under the first tariff trade war with China, it took 18 months just to get the phase one agreement in place. And even then, it was pretty vaguely worded. There wasn't, there's an agreements there, and the Chinese did fulfill most of those, but not all of the components of the phase one agreement. But that still took 18 months to negotiate, and that was just a partial deal. So please, as you think about this, when we look at China and, when we look at Japan and South Korea, we already have bilateral agreements with them. Those are already in place. So to get those trade agreements revised, or at least identify what parts of those agreements need to be updated, will be a lot simpler than trying to come up with a true bilateral agreement with some of these countries. So I want to set some expectations. We're probably going to be talking about this for an extended period of time. I did put this together, some graphics, because I get some questions about the export pace. Not only the volume, how much have we sold, which I've talked about before, but what is the normal seasonal pattern? So this is cumulative export sales, which means that every time that there's a new export sale, we add it to the pile. So the real question is, how fast is these piles of exports growing? So if you see a time period like in the red, which is our current marketing year, back here early on when we were getting into harvest, we had some very, very strong export sales. So as this goes up rapidly, it means we're selling large amounts each week. So this is weekly data. Okay, but then later on in the season, when it starts to flatten out like here, that means that, yeah, we're making some additional sales, but they're relatively small. And so our rate of gain, or the pace of new sales, is really starting to slow. So we do see this seasonal pattern in corn exports. It's not as dramatic as it is in soybeans. And I listed these different marketing years from 2019 through what we see today. This is as of the data yesterday. Now, just for reference, this really bold black line on top, all of the lines will be colored the same, okay? So this big black line on top, that was that phase one agreement. So you can recognize and see we had a pretty good export pace going, and then all of a sudden we got this phase one agreement, and we saw these big chunks, or this rapid acceleration, kind of counter-cyclical or counter-seasonal. Now, where are we today? We're ahead of where we have been the last couple of years, pretty much right on pace with what we saw in 21 and 22. Now, the big question everybody's asking is, so we're on kind of a normal pace. We're having a really good export season for corn. Will this continue to go straight? No, it won't. I mean, just seasonally, we're getting now into the time of year where our sales, the amount of extra bushels we sell into the global market, starts to grow, and that's starts to slow out, excuse me. And that's also one of the reasons that all this discussion and negotiations and turmoil in the global markets really hasn't spilled over into the ag markets as heavily as what I was expecting, nor as heavily as what I think others in the ag industry were expecting. It's just because of the timing issue that I'm trying to get at. So what would I anticipate? What would be my best expectations? I do think this red line will probably follow something similar to the gray line. That would be my best set of expectations. Again, this would be primarily for old crop corn, which again would have some pricing implications for new crop corn. Moving to soybeans, same graphics, same explanation, but this is soybeans now. Again, the black line is what we saw during the phase one trade agreements. We had some very, very large export sales. Not all of that was to China, but a significant portion was. Again, today in the red, we've seen some better export sales than we have in the last couple of years, but nowhere near the levels that we had seen either before or shortly after the phase one trade agreement and the previous challenges with exporting into China. So what would I expect to see right now moving forward? Again, my expectation is we see this rapid expansion of export sales during our harvest and into the first part of the year, and then things start to slow down fairly quickly. I would anticipate, again, that would probably follow a trajectory, something similar to this yellow line. So I do think they will start to flatten out, given all of the uncertainty of what's going on and basically the size of the Brazilian soybean crop. I think for the next several months, it's going to be very difficult for the United States to be an aggressive seller into the marketplace. Now, this is for all wheat. I'll show you spring wheat in just a moment. Kind of the same basic story. Today's levels in red are well below what we saw during that phase one agreement time period. We're ahead of the last several years of our export sales. We're having some better years, but notice that we have a pretty stable, steady growth. So this is almost like a straight line until we get into this spring's work time period. Then it typically starts to level off. So again, I would expect the same kind of general trajectory. I would expect to see relatively slow export sales coming into spring's work, unless, this is the big question, unless there's some major weather problems somewhere around the world, and there is some challenges starting to show up in different locations, which I don't have time to talk about right now. For spring wheat specifically, a similar kind of story. When you look back historically, what do we normally see is almost a straight line. That means we have a very steady export sales each week. But then as we get into the spring's work time period, we tend to slow down. So my moral of the story is if we're going to have some turmoil in the global markets, if we're going to have if this has to happen, now is actually a good time for ag markets, in particular the grains, simply because it is a time period when we are not typically selling a lot of volume of grain into the export market. Now, if this turmoil continues as we get closer and closer to harvest, my viewpoint and my opinion is as we get closer to harvest, then all of these trade negotiations and trying some of the potential turmoil is going to have a bigger and bigger impact on grain prices directly. Okay, I'm sorry. I am sorry, that's my phone. Okay, so what does that happen to pricing? And I'm almost done here. I pulled these charts as of about 12:15 this morning. I just wanted to show you that our current price level for corn is actually above what we saw during the harvest levels. So even though we've seen a recovery, a lot of volatility because of the trade issues, the corn market, at least for old crop corn, so far has not been dramatically impacted. Now, I'm not to say it's not going to be impacted in the future, but as of right now, again, the futures market for corn, soybeans, and wheat have been, in my opinion, pretty resilient. They've been watching the trade problems very, very closely, but it's not been significantly impacting futures market trade, which of course would potentially impact cash market trading. Looking at soybeans, we've had a bit more volatility. We're looking actually at price levels very similar to or slightly higher than what we saw during the harvest time period. Did we see some improvements earlier in this marketing year? Yes, we have. We'll have to wait to see what goes on moving forward. But again, my point is we have not seen this really dramatic drop-off in prices like we saw during the first trade war when agriculture was more specifically targeted. Now, finally, for spring wheat, we're having some issues with the spring wheat market. We'll have to wait to see how this plays out. But again, at this time of the year, we don't typically have a lot of real strong and aggressive export sales. Fortunately, some of our big buyers of wheat, both spring wheat and regular wheat of Japan and Mexico, are negotiating with us. It seems as though they are still buying some of those products. This is my last slide. I showed this before. This is just a recap of, the real question we have is what is the objective of all this? What's the end game? When do we know we have reached the objective? It's still very unclear. And that also is causing some of the underlying confusion on saying, well, what might this look like? How might this play out? And I guess it's this last bullet point. I showed this last time, but it's this last bullet point that I'm most concerned about, is that the timelines, the length of time that these tariffs are in place, makes a difference. So if the tariffs come up and we start looking at alternative supply chains, where countries start buying their ag products from other customers or are some of our competitors. Once those supply chains get into place and become very, very efficient, it becomes harder for those countries to think about or switch back to buying from the US or going back to the more traditional supply chains. So in my mind, one of the key things that we're worried about is it's a timing issue. If we get some bilateral trade agreements, we're able to settle down the marketplace, that'd be fantastic. The sooner the better, in my opinion. And if we do have some problems, like in the Chinese market, some of those might be long-term and create some longer-term issues for us. So with that, I will stop sharing. I'll look forward to your questions during the Q&A session.
Good afternoon, everybody. Tim Petry here. I just want to follow up, and Frayne gave an excellent introduction to what I'm going to talk about. And so I'm just basically going to update some things that I talked about last time. So just to begin with, and I've said this before, but here it is in numbers. The U.S. is a major, major player in the world meat industry. We're one of the largest producers and also one of the largest exporters. So, going down, looking at the major meats, we're the leading producer of beef in the world. On exports, over there, I have a 1 and a 3. We are the leading exporter of high quality beef, and on a value basis, right now, 2 other countries do export more than us. Brazil exports quite a bit more than us. Australia and us flipped back and forth. 2 years ago, we were ahead of Australia. They were in the rebuilding phase because of their herd liquidation before, and now they've rebuilt the herd, so they're back up to number 2 in volume, and we're number 3 in volume, but we're still very important. In pork, we're the number 2 producer, only behind China, which is huge, but they consume all their pork there. So we're the leading exporter of pork. We're the leading producer of chicken, and the second leading exporter of Brazil, that I'm going to talk quite a bit more about here in a minute. That we're behind Brazil, and we're always the leading exporter of chicken, but Brazil has bypassed us, and as we'll see in a minute, they're increasing everything, and then number 1 in both turkey production and exports. So want to look at our major meat export customers. I showed you this last time, and so I'm just going to basically update it, and really not a lot different. And again, Frayne set the stage very well. I'll go to the easy one that he just mentioned. Mexico and Canada show up as very good customers because they're so close. They're down there at 4th and 5th in beef, and you see Mexico is our number 1 pork, and Canada right down there number 4, and Mexico and Canada 1st and 2nd in chicken. So as Frayne said, there's no retaliation from those, so we're going along as normal, which is good. And then let's just go back and pick up, beef and go across a little more. Frayne mentioned Korea and Japan. And again, we do have those bilateral agreements before that were negotiated in the previous Trump administration, and want some tweaking there, but I completely agree with Frayne. I think that's going to be relatively easy to do, and we've seen good volumes continuing with Korea and Japan, and you see across there as well, Japan on pork and Korea. So that's good news. We're still selling product. The big bugaboo and for us, and that Frayne also mentioned, is you see China number 3 across there as a customer for ours, and we are definitely really struggling there on the meat side with China. Have almost won't be long there till probably we'll go to about nothing. In the case of China, they already had a tariff I think 12% on beef, and then we added another 10%, then we added another 125%. So we've got 147% tariff now on beef, which really restricts things. And on top of that, China had to approve new meat plants for approval to export them. And a lot of our particular major plants were not approved. So that market has, very much declined, and a little bit more on that when we get into some other things. And, same thing on China. They had an even, because of previous agreements and so on, a 37% tariff, add 10 to that, add 125, got 172% tariff in China. So very little pork. You probably seen a news release today said that also they're canceling many orders that they had before, some major orders that we had already, USDA had put down as sales. Now they're canceling those, and because, it's just way too expensive there, and kind of the same on chicken there. So for the bottom line is, for most of the countries, things are as normal and we're doing okay. For China, our meat imports have been declining every month, and basically probably are going to near zero. And so, like Frayne said, the longer that lasts, the more of a problem that will be on prices and so on. And we'll see in a minute. Really, it's too early now to have had much of an impact, but something we have to watch. So, as Frayne said, the longer it goes, the more other countries might want to come in and take the market. And then it's, we have the reputation of having very high quality, the safest, most dependable, most reliable meat supply in the world. And so even though our prices are higher, we have, sell a lot of meat in the world because of that. But the dilemma now is, once we lose a market to another country, as Frayne said, it's a lot more difficult to get back. So take a little bit at a look at what our competitors are. And in beef go across here, beef, pork, and chicken. Brazil is a major competitor of ours. They have been increasing production of all three of those. They continue to increase production, and they're increasing exports. And so they are, I think maybe very pleased that China is slapping tariffs on us, because it just opens up the market more to them. So, hopefully we can get things settled out there. And I mentioned Australia and beef. Now they've increased their herds back up and have a lot to export, and they're closer to China than we are as well. So, I don't want to go on and on about Brazil, but they are a major competitor. They are going to continue to increase beef, pork, and chicken production, quite likely. And I think maybe some on the crop side too. So they're going to be more and more of a competitor, and they need a market. And they are certainly looking at China and even our other markets now. So just a little bit here. This is just a Reuters from column from earlier in the week, kind of along those same lines. This pertains to China and Australia that I mentioned. And there's this Home Plate Barbecue, which is a big U.S. barbecue restaurant in China. And just go down to the bottom. It says Home Plate Barbecue, an American-style restaurant in Beijing. Staff are reprinting the menus. The U.S.-China trade war means American beef, once the star ingredient, will soon be off the table. Home Plate's beef, previously sourced entirely from the U.S., is increasingly Australian. The restaurant uses 78 metric tons of brisket each month. And when the U.S. beef in the freezers are used up, it will be all Australian meat, because ours is at a standstill. So again, once we lose that market, Australia is closer to China. That's going to be struggle. So it's important for, negotiations to take place there. Just a little more. I talked about this, but just to show you, using pork as an example in muscle cuts. Again, we export a lot of byproducts that would be included this, but this is kind of the same for beef. In terms of muscle cuts, we're altogether, we're still hanging in there because all the other countries are taking about the same from what we did. Just isolating China alone on the bottom, you see now that they've basically went to zero because of that 172% tariff there. So, we are not, I'll look at the prices in a minute. Haven't seen a lot of price impact yet, but the Chinese market is certainly in jeopardy for us. Just a little bit on chicken. Again, I took this from the National Chicken Council, and already we're on major export statistics of what actually goes there. There are sales that can be canceled, like's going on, but actual product that gets there, you go back to this is for February. And so you see already in February, we reduced chicken exports to China by 70%, and that's continuing on. And just a hate to keep beleaguering the other countries that are stepping in to get that market. But down below is an article, a news article out referring to Argentina, and see there in blue that exports were suspended back in March of 2023. Exports of poultry from Argentina to China because of avian influenza. And again, China does use those types of things like avian influenza, or they used it back when we had BSE in 2003. We didn't get back into China just a couple of years ago, and they use that as a non-trade a trade barrier. But when they need it, then all of a sudden things are okay. So now they just negotiated, and China is opening up to Argentina poultry to send there because again they aren't getting it from us. So again, when they get in there and that is competition for us. So just kind of look at the futures market like Frayne did for the different commodities. And again, when I talked to you the last time, we were right after that April 2nd announcement, and a lot of turmoil there. And so when we talked to you before, the futures market for about everything, I'll just go back there to that April 2nd, we're declining. But here's feeder cattle futures, and which for that week they crashed. But then as things leveled out a little bit, and we are short supply of cattle, and the demand is good, and so on. The futures market now has picked back up, and so we went from about 287 there down to 270 on the futures, and rapid decline. I had a lot of concern, but now we're back up today to 290. The cash market really wasn't very much affected, but the futures got the big jitters. But just like on the grain side, they come back over on live cattle. The same story. We're up there at 207 down to 193, a rapid decline there right after that our announcement there. But now they're back up even to higher than they were before, 208, and go down to milk that had been declining throughout the year, again with expected higher production. The USDA is predicting because of more cows and so on. But a decline there, 17, about $1. It maybe looks like more than that on this chart, but that's significant for milk, from 17.50 to 16.50. But now back up. And China is a big market for us for whey that they use in feed and so on. But that market is recovered, and kind of the same thing over here on hogs. As we had that rapid decline for a week there, and $90 or so down to 83, but back up to about $93 on the futures market day. So we, from the futures market standpoint, we've kind of recovered from that big shock. And so again, remains to be seen and go into the future. And we're negotiating, just something I didn't mention back there, on pork exports before. Mexico is a major customer for us. And one of the big things we're negotiating with them is we have an agreement with them on potatoes that we won't do any retaliation or something for tomatoes being sent here. And the Mexican president has already said, if you start putting big tariffs or something on our tomatoes, guess what? The first thing we're going to do is put it on pork. So again, a lot of back and forth, as Frayne has said, and so on. We don't know what's going to happen, and certainly there's, you know, progress is being made with Mexico and Canada and some of those other countries, so I have to wait and see on that. So, you know, back just to finish up more on cattle and beef, the boxed beef cutout is what packers can sell into the wholesale market. Whether that goes into the export market or the domestic market remains strong. We're right up there at record high levels. And, you know, just to have backed off a little bit there in the last week, but, you know, just a very much seasonal thing. And, you know, the cutout value this morning was 335, and last week the average was 333. So we're going to be about there. So beef is moving. The cold storage report just came out and it's not being backed up. So demand is still holding there. Although, you know, into the future, China is going to, you know, that's going to be something to watch. Back on fed steers, then we have basically the same thing, because the cutout value is higher than it was last year in record high levels. Fed steer prices continue to be near record high, 212 last week. And, you know, someplace in the South, maybe they were off a little bit this week, so we'll see, but not a big change there. And the futures market in red out there, the April is about ready to close here, but into the others showing better prices. But, you know, that's the trade now, is basing that on demand holding and continuing a good export market and so on. So things look good now, but as Frayne said, you know, if things worsen and we get into more trade issues, things could happen fast there. And also then that's the same thing on the heavier weight feeder cattle that are selling very well at record high levels. And again, bolstered by short supplies, 6 straight years of liquidation on cows, and then the fed cattle holding there, and corn kind of remaining at moderate levels. So just have to wait and see what happens, and hopefully we can get the trade straightened around and keep going here. So with that, stop sharing and turn it over to Dave.
Yeah, so Dave Ripplinger, bioenergy, bioproducts, economic specialist with NDSU Extension. Going to cover a few things today. I'm actually going to begin with talking about a more general trade issue than just bioenergy, and that relates to the strong dollar. We know this pretty well, being in North Dakota, because we have a very much export-oriented economy. If it's out of state or eventually out of country, we know that exchange rates impact trade. And that in general, as agriculturalists, again, with the amount of exports that we have, we typically would prefer a weak dollar. That is, that would make our products, our agricultural products, less expensive on the foreign market. We're at a point right now where we've actually long been where we have a strong dollar. So we've actually had this policy, and it's been generally to the advantage of the nation, citizens, and most parties that since it's been in place. We've talked last time a little bit about foreign investment, which is a natural consequence of this. One of the big reasons is to keep inflation low, to allow us to maintain a rather stable macro economy, and then also to preserve our dollar's reserve currency status, which is another relatively big issue I won't go into too far. You know, for us, again, either as importers or exporters, that exchange rate makes a difference. You know, we've historically had this policy, and we've almost always had a strong dollar for the last 80 years. It's led to a few things, you know, for better or worse. Imports have been inexpensive, so we have a lot of purchases, imports of things. We have consumers buying a lot of things, you know, like consumer-driven economy. But that strong dollar has also made our egg exports more expensive to those foreign buyers, which could be taken as a negative. One of the things that I've been following is, you know, what's happening in the bond market, what's happening with the U.S. dollar, because to me, those are the other big structural changes that could really impact long-term status of agriculture and the U.S. Globally for quite some time. And without question, the dollar's gotten weaker in recent weeks. And even within this chart, we talked about similar things last time. We're still within that range of where we've been. It's important to note too, this is the dollar index. So this is against a basket of a variety of currencies. The dollar in general is weakened against, all major currencies, some more than others. And again, this balances all of those out to give that more general picture. Of course, now if we go back and look, kind of extend our window a little bit, if we go back to the even the beginning of the Great Recession, we're at a period where we have an even stronger dollar than we've really had for 20 years. And that really came about post-COVID. And so even though we've seen this dip, relative to where we've been, even just a few years ago, the dollar is significantly stronger. And again, the question is how much might that shift and permanently is a macroeconomic question, and one that again would really impact North Dakota agriculture and really almost all of the crops that we grow in the state. Next thing to talk about, I'm glad that Tim touched on Brazil, this idea of possibly losing markets. And I know this is, I think, general knowledge, although not headline information for most of us. But Brazil has been putting on a number of corn acres. Much of that corn is now going into corn ethanol production. That ethanol needs to find a home. Brazil is a major consumer of ethanol. It's very much part of those higher level blends. A 27.5% ethanol blend is, required across the country. So, it's very much a used thing, but as more supply comes online, this is available to fill what we might lose. One of the things, Frayne mentioned of the conversations that we've had with various trading partners. If you remember back, almost immediately after the announcement was made about retaliatory tariffs, I believe it was the next day, Vietnam contacted the United States and said, they're ready to negotiate, to make deals. And one of the things they did do is drop their tariff on U.S. corn ethanol from 10% to 5%. And so that's, one of those moves that certainly does make a difference. But again, this is just something to note too, again, of what's happening with one of our competitors. About a week ago, Frayne asked me if I could make a slide for him or find data for him on imports of used cooking oil and the like. And so I put this chart together. And again, it's measured in million metric tons, which kind of confuses things a little bit. But the level of growth in these different ingredients that we can use to make renewable diesel, you can make biodiesel with it as well. But we typically make renewable diesel with these products. There's tremendous growth, especially within used cooking oil. In the last 5 years, a tenfold increase in those imports. And I'll give you a little bit of additional understanding of kind of what that means in just a second. So where's that coming from? Also important as we talk about now, we're seeing this diversity of tariffs, either imposed by the U.S. or retaliatory and the like. We do now get most of our used cooking oil from China. If we go back even a few years, there was essentially none. There were no imports from China or from most countries, and this is changed quite quickly, quite significantly. Very much a concern of the domestic biofuel industry, the vegetable oil industry in the United States, and others. If that used cooking oil is actually used cooking oil or something else. One of the big drivers of its value in the United States is its carbon footprint. And if it's not really used cooking oil, that carbon footprint is likely quite a bit higher. But again, we've seen from the chart before that rapid growth, and then here specifically for used cooking oil, where those imports are coming from. And it leads to two interesting things. There's a statement made, if we have these higher tariffs on Chinese products, that will make used cooking oil more expensive, which could, we'd expect that would reduce imports, providing a bigger home for domestic feedstocks, be they vegetable oil, fat, grease, generally supportive of U.S. agriculture. There's a bit of a concern that, came across my mind if we think about the decision recently made by California Air Resources Board. So if we think of, the state of California being the home to the destination for almost all of our renewable diesel, also Oregon and Washington are out there with LCFS as well. They did just impose a cap on the amount of vegetable oil that could be used for biomass-based diesel if you wanted to produce, if you wanted to participate in the program, have a smaller footprint to be able to generate credits. That doesn't go into effect for a couple of years. In the case of those companies that already have approved pathways, but if we don't solve things quickly, and if we do see this dramatic decline in used cooking oil imports, used cooking oil use, you need to understand that essentially the pie would shrink. We'd still be stuck at that 20%. And that could be a relatively bearish outcome. I did some math to look at how big that might be. If we took those imports, and again, this is just used cooking oil from China, that translates to about 300 million gallons of biomass-based diesel. If there was a 20% cap, again, in California, it'd be limited, or there'd be, and again, the idea is if we no longer imported this used cooking oil from China, we would no longer produce 370 million gallons of biomass-based diesel with it. Thus, we would lose a home for 74 million gallons of domestic vegetable oil, because it's almost certainly going to be domestic. And doing the math fully out, that's the same as if we lost the home for the oil from 105 million bushels of soybeans. So a relatively bearish thing. And one of the things you had across, and we've talked about this a lot, where there's kind of, there's a variety of winners and losers, and there's a variety of primary and then secondary impacts of policy, some positive, some negative. This is one where, because of a policy that's very much removed from trade policy, could have a significant impact on domestic agriculture. Last thing I want to mention, because I still get this question all the time, is carbon still a thing? 45Z is not being rolled out quickly. At the same time, there are many other actors domestically and internationally who are very much interested in carbon. The European Union is very much one of those places. The European Union is very much one of those governments that is supporting decarbonization. CBAM, which is the Carbon Border Adjustment Mechanism, it's a fee charged on imports into the EU based on their carbon footprint. It doesn't take effect for a bit. I believe it's 2027. At the same time, people are very much preparing for this situation. And one of the reasons I bring this up again is because this is very much, it was brought up this week during a conversation, this is a protectionist policy. And the idea is that the EU wants to protect businesses that are burdened by their own policies. For better or worse, it might seem odd that you would do that, or natural that you would do that, but very much a case. And again, the reason I bring this up first is that carbon is still an issue. This is having this CBAM program will have a tremendous impact on a variety of U.S. businesses, certainly not just agriculture, and actually more so manufacturing and other industries first. And then also, too, as I mentioned, there's other barriers to trade. It's not just tariffs. Those were my prepared remarks. With that, I'm going to stop sharing and we'll move over to questions. I know that we have one to start. Folks would like to use the Q&A tool. I know that there's a variety of expertise among the panelists that we'd be happy to share with you, but that's really only comes to a head if folks ask questions. I'll go ahead and jump into the first one. Brian, if you're up and ready.
Yeah.
Yep, go ahead. You want to read it and go?
Sure. So basically, the question is, with my job and employment numbers, would that potentially drive up salaries or pay rates? Well, in theory, yes. In fact, but there will be typically in those cases, there's a bit of a limiting factor though in that, and that's investment in labor saving capital technologies. So to bring that home to an example, in agriculture, there's been a labor crunch for the better part of over 100 years. People moving into cities for wages and things like that. And so how did agriculture solve that problem? Bigger equipment, more expensive equipment that can do the work of multiple workers with just one worker operating it, right? And that's continued to go that way. You think about supermarkets, grocery stores, or McDonald's, where you replace cashiers perhaps with kiosks where you go in and order, and the food service workers make it for you, and you go pick it up yourself and you pay at the kiosk. So that's a long way around the saying, yes, it should drive up wages and make it competitive still, but that is not all going to be put on just increased wages and competition there. It's going to be invested into labor saving technologies at the same time. So there is a little bit of an offsetting, but the bottom line is it will make production more expensive, whether you're investing it in capital or whether you're investing it in higher wages. It's going to be probably some combination of both. So yes.
And one thing, this is usually I say I'm not a soil scientist or I'm not a geologist. I'm also not a macroeconomist, but there's long been a concern about increasing wages and their impacts on inflation. That's old Phillips curve stuff.
Mm-hmm.
And so, if we put too much pressure on labor and wages, that can cause, rapid inflation and a spiraling. And I don't know if that's still part and parcel of general macroeconomic theory, but that for decades it certainly was.
It is, and that kind of goes back to my circular feedback loop, saying the stagflation thing is kind of a unique scenario where unemployment's high, so wages in theory should be falling, but inflation's going up, which is the opposite of what you would expect to happen. In this scenario, we could have higher inflation, prices being driven up by not just trade barriers but wages being driven up and everything else. But if it doesn't come along with that high unemployment, you do have a bit of a feedback loop. Then higher wages can put pressure on inflation, and then you would expect GDP growth to at least clip along at a reasonable rate if people are still spending money and not unemployed.
Yeah. Next, there's actually two questions that are somewhat related. I'll take them one at a time, but there's likely going to be a little overlap. The first one referencing imports of Chinese tallow, its impact on renewable diesel. Would that mean we would use more U.S. soybeans? And the answer in the short term is that's the expectation. Again, if we're going to be importing less feedstock, and especially given, again, the policy says we want low carbon fuel, and we can deliver low carbon fuel very well with soybean oil based renewable diesel or biodiesel. So that seems natural in the short run. If we can't import those feedstocks, Washington, Oregon, especially California, will be looking for low carbon fuel. That soybean oil based diesel is really going to be in a much better position. Kind of going back and kind of giving that insight on how those, again, it can be used cooking oil or tallow, any of those things impact veg oil markets. Again, in the short term, because we have businesses that have approved pathways, so the Marathons of the world, the Chevrons of the world, they have approved pathways. They still have just under 3 years to drop to that 20% ceiling. For the next 3 years, we could be using more canola oil, more soybean oil, more domestic vegetable oil, fat oil, grease. Again, that would be supportive. That would be a bullish thing. At the same time, when we hit 2028, if we don't have the used cooking oil, or better put, those non-food vegetable oils, the pie is going to shrink. So in 2028, we have a 20% cap. So we get this much of the pie. Well, if that pie shrinks because we don't have those other feedstocks available, that will be a bearish thing for the vegetable oil market in the United States. That's a few years off. There's a whole lot of things that could happen between now and then. And I would fully expect that between now and then, many things will happen where that may or may not be an issue. But, a potential home or loss of a home for 100 mil, the oil from 100 million bushels of soybeans is a big deal. I mean, it's almost equivalent, our interest and recognition of the value provided by the crush plants in the state, that's, roughly on par with what this is. This would be potentially the loss of that much of the pie. And that would be bearish. Again, 2.5, 3 years out. So I wouldn't lose any sleep over it right now. But again, it's one of those, again, the main point, one was to bring it up, but then also to recognize there are these secondary, tertiary impacts that we don't even think about that can be relatively significant. So we don't have any more questions. Any of the panelists have a last comment or a question for anyone else? Frayne, do you think your numbers are still accurate 40 minutes later?
Well, from what I could tell, no new news, so we're good.
Sounds good. Well, with that, I'd like to thank everybody for attending today, for all the panelists for joining us. Right now, we're scheduled to be back on Thursday, May 15th for a regularly scheduled webinar. And I hope that everybody enjoys what hopefully is the real beginning of spring.